Hi, everyone. My name's Ryan Weeks. I'm the Fintech Correspondent at Financial News. This is a panel all about custody and what institutional investors are looking for. And we don't have too long, I don't think, and we're a little bit behind schedule. So we're just going to start with some quick-fire introductions. Dima, if you could go first.
Sure. Hi. Welcome, everybody. I'm Demetrios, Skalkotos, head up the global enterprise vault solution for Ledger Vault. We are a tech platform for folks that want to self-custody or offer a custodial solution in the marketplace.
Great.
Hi, Stephen Richardson from Fireblocks, VP of Product Strategy. We're also a technology provider in the custodial space, offering solutions for institutional customers that are looking to self-custody as well as connect to their different exchange venues.
Hi, my name is Swen Werner. I'm a global product manager for State Street. State Street is a large global custodian, and I look specifically at the development of digital assets as well as blockchain deployment.
Hi, Cara Kennedy. I'm part of the Custody Business Solutions Group at BNY Mellon, another major custodian. And my focus is around looking at digital asset capabilities in terms of our custody services.
I'm Pete Najarian. I'm the Chief Revenue Officer at BitGo. We are a qualified custodian in the U.S. and a technology provider of wallet solutions.
Great. Well, I'd like to start by saying that as a journalist in this space, I get probably more pitches about custody in cryptocurrency than anything else, and it seems to have really intensified this year or in the past couple of months, let's say, and both from startups and sort of established financial institutions. So just a question to the group, why do we think there's this seemingly a sudden sort of rush to get crypto custody solutions to market at the moment? Who would like to take that?
I'll start. It's two things. I think there's a real client demand that's building. So places like BNY and State Street have real inquiry in ways that they might not have had 2 years ago. I don't want to speak for you guys, but that's what I see from similar clients. There's also been, this is a space within crypto that the private equity world has wanted to invest in because it's considered a part of the crypto ecosystem, if you will, that infrastructure that's easier to understand and it is easier to quantify in terms of what revenue streams could look like, et cetera. So post the December 2017 spike, it began in earnest in early 18, where new entrants to the market were out pitching solutions and getting funded and have now come and you know, if anything, the competition for crypto, within the crypto custody environment overall, the competition to be that custodian is, I think, surpassing what the real institutional demand is today. The institutional demand will catch up, but the infrastructure of custodians is fighting for a pie that's not really grown up yet.
And just before we get some other thoughts on that, obviously BitGo is one of the earliest crypto custodians. You know, what are your thoughts at BitGo about all of these new entrants in the marketplace? Is it a good thing? Are you concerned about competition from larger organizations?
I think that, so I'll give you a personal view, but I think it's a BitGo view as well. It's important for the huge incumbents to arrive. I mean, I think that's important for this whole thing to work. And we haven't enjoyed the new startup entrants to the market coming in and offering services for free because they're just working on a runway of private equity capital and are trying to buy clients. We don't think that's good for the ecosystem. Competition is always a good thing for everyone, but most importantly, I think the arrival of brand name custodians is not a bad thing and is actually a healthy sign for the business overall.
Would anyone else like to tackle that first question? Would you agree with those comments?
I mean, I think from our perspective, it's a conversation that has just been evolving over the past few years. You know,
on the whole, did you say so?
On the whole,
right.
You know, so I think obviously after the spike a couple of years back, that was when there was a lot of discussion, and I think a lot of immature discussions around, you know, how entrants like ourselves go into the market. I think we're at a much more mature level now in those conversations about what that really means, and I think some of the comments, Pete, that you made earlier around, you know, what that means in terms of an institutional custodian having these assets, backed by their balance sheet, and the potential impact that has on a business like ours is, it is getting into that level of detail. I think what we've also seen is maturity in terms of some of the proof of concept initiatives that have been going on, perhaps more in the permission space than in the public cryptocurrency space, but that helps to bring the kind of the more traditional institutions.
Would you mind just giving us a few examples of those sorts of projects that you think have spurred on some of this activity, in the permission space?
Well, I guess one that we're involved in alongside State Street is the what was formerly called the Utility Settlement Coin project, which is now operated by Finality International, and that is really looking at how to advance the payment infrastructure on chain, and looking at how to connect the fiat currency ecosystem into the on-ledger space. And that's, I think that's a critical component, particularly as we're talking around bringing institutions on board and bringing institutional custody services, is really solving that settlement issue, being able to look at how we deliver things like delivery versus payment, which is is something that is ubiquitous in this traditional space, and must be able to be effectively solved in order for this market to really develop and mature.
Maybe just to add on this, your initial point around people considering custody for crypto assets somewhat of the holy grail of that industry. And in my opinion, this is maybe articulated both for the wrong reasons, but also a bit counterintuitive. Counterintuitive from the perspective of you're trying to create a peer-to-peer network, why you reintroduce a level of intermediation. And there are good reasons for that, but it's not, I think, sort of would have been my ingoing position. But the other thing is what Carl mentioned around maybe a misunderstanding sometimes what custody is. So this point around lending the balance sheet. As a custodian, I typically hold assets and they're off balance sheet, so that means we do not necessarily insure those assets. So therefore, the idea that if traditional players were to go into the crypto custody market, you therefore had players with deep pockets that would write insurances, I think is a bit misplaced, because that's not the business we're in. Where there could be a benefit really is to bring a lot of the experience and tradition, and also that interface between, if you want, investments in traditional assets and new assets. So where we see really an area to play is an investor that may have an existing portfolio and they are looking to add some crypto to that. And how do you normalize across, if you want, the traditional world and the new world? But this is somewhat different to how people, particularly from the fintech world, sometimes maybe imagine custody to be. It's a much more mundane and much more sort of ingrained in regulation and supervisory standard than people anticipate.
If we just try and lay out the landscape a little bit better, I think it's fair to say we've got a sort of a well-established startup, two incumbent custody providers, custodian banks. Here we have at the end with Fireblocks and Ledger essentially startup technology providers that are working with incumbents to offer custody solutions to clients. Is that correct?
That's correct.
And perhaps you could talk a little bit about that approach and the advantages of that versus being a pure startup or even an incumbent.
I think from our side we've seen kind of a maturation of trading providers coming into the space. Our view is we're looking to support those, and from a technology perspective, we get a wide range of views across different workflows that are coming into the space to support different models that have been traditionally in the banking and financial services space. We are a pure technology provider. We don't necessarily are looking to start a financial services firm. So when we have these conversations, and it's in the basis of really understanding what are the limitations with the existing solutions that they have, how are they looking to grow and scale, and then what products they need from a feature set perspective that we can provide on the other end, right? And we typically see, from a Fireblocks perspective, that all the products that we typically put to market are working, jointly with an existing set of customers in order to deliver those and then provide outcomes that we think are broadly successful. So, we have just a generally targeted focus on being a technology provider and providing technology solutions, whether those be to large custodial banks or small trading firms across the spectrum.
Mm-hmm. And Dima, you're involved in the Kamenu project, which also features Nomura, which has recently won a license in Jersey, I But
Yeah,
can you talk us through a little bit about that, and now that you're actually in the market, what sort of demand you're seeing?
Yeah, if I can give a little bit of a brief history on Ledger. I mean, we've been in the business for...
Sorry, the Kamenu project
yeah,
specifically, I mean, in the market.
Yeah,
Yes.
but I want to make if I can at least articulate that we've been in the security space for 5 years, obviously started on the retail side with our Nano product that has sold, over 1.7 million devices in 165 countries. And that demand from that client base has asked us for an enterprise offering. So we launched in 2018 and partnering with Nomura to create a joint venture between Nomura Global Advisors and Ledger, where the Ledger Enterprise Vault will be the underlying technology for that regulated insured entity that will launch hopefully later in this quarter or early next quarter. And that's what our mission is. We're similar to the other tech providers in that clean business model. We want to provide a very secure end-to-end technology platform that is flexible and scalable and provides instant access to funds, where I think that's where the industry needs to go. And you heard it from the previous panel. I think having complete end-to-end security with an encrypted channel and eliminating that man in the middle, eliminating those human elements that are grabbing things out of cold storage vaults, I think is a far we supply a far security superior product to that space.
Okay. We touched on this a little bit already, or Cara touched on this a little bit already about the sort of variety of demand that we're seeing for crypto custody products, and that's it could be investors in Bitcoin, it could be people looking at tokenized asset classes, it could be people looking into sort of reporting projects. Can we just go through the panel and talk about sort of the range of demand that you're seeing, and then try and sort of work out whether the startups are seeing one thing, the incumbents are seeing something else?
If I can, I think from our perspective, we want to be asset agnostic, right? For us, we want to support any critical digital asset, whether it's currently Bitcoin or Ethereum, or it could be securitized tokens, it could be your passwords or PII, it could be information that you're sending from your doctor on your pacemaker to your doctor. Any critical digital asset is in our purview at Ledger of what we're trying to secure. So whatever the underlying digitized assets that it is, Ledger will be there to secure it and transmit it and store it securely.
Okay.
I mean, I think from my perspective, there's a fundamentally different view of a large fund manager that has other assets that are custodied with State Street and BNY, and a fund that has $50 million to $75 million trading, and probably may or may not get accepted as a client to BNY and State Street. And what are the solutions that you're going to take around that, or lending platforms and other things? And so from our perspective, we're really looking and saying, how do you enable folks to continue to operate their business in a world right now where the State Streets and the BNYs are still exploring, and potentially that may not be a solution for them to be able to use, right? And so we've said there's certain characteristics from an enterprise perspective that need to be there. The security from an end-to-end perspective, the ability to integrate compliance tools, the ability to integrate against your different venues and to limit the level of human touch and interaction that's needed to operate your business. And those are certain things that from a large custodial perspective are important, and all the way down to an upstart institution are also important. So we don't necessarily designate between whether we're seeing a very large fund. We're kind of saying, from our perspective, whether the solution doesn't necessarily cover everything, and so what we can do is provide services out there for the gaps that we think are going to exist from a large custodial basis.
Mm-hmm.
Maybe from my side, the key difference for me is whether that asset manager institutional investor is regulated or not. So if today you look at collective investment scheme like UCITS in Europe, a 40 Act fund in US, they are not invested in crypto. We should not fool ourselves. I would say there's an interest to explore that under the right circumstances, and that's both a function of custody and regulation, a lot of other things. But I would say there's even a higher interest in the security token side, so using blockchain, broadly speaking, for the deployment of regulated assets. Now, that is obviously the bread and butter business of global custodian in the likes of State Street. Now then there's this other aspect around smaller fund managers that may not necessarily fit into these established regulatory frameworks, and yes, they are interested in investments in crypto and are looking for solutions. But the key thing for me is really that scaling up an organization like State Street, servicing trillions of assets under custody, and the market both for crypto as well as security tokens is nascent and is small, and it needs to find the right players with the right cost structures to put services out there. But I think before you would see household asset managers that manage your individual pension, and for them to put money into crypto, I think we're still a little bit away from that scenario. I don't see this happening this year.
Cara and Pete, would you agree with that? What sort of institutional interest are you actually seeing at the moment? What kinds of institutions are interested in investing in crypto?
So I think we have conversations across the spectrum of our clients. So everything from pension managers, sovereign wealth funds, down to family offices, wealth managers, and everything in between. Clearly, as you would expect, the alternative space is really out front, and in a lot of our clients are already engaged in this market without us. But that's not to say that they don't come and look to us to try and support them and evolve our products and services to enter this space alongside them. What I would say is that I think I agree with Sven that the traditional fund managers are probably more focused on the asset tokenization opportunities, and look to us to also engage with them as they explore those proof of concepts. So they'll be asking us to participate and open our eyes about what that custodian role might look like, and we're very clear that the role that we play as a custodian may change in its form. There will, I expect, always be clients that will look for that full service model who don't want to be connected directly to these to platforms or networks themselves. They want us to do that work for them. But then I expect that there would also be clients who would want to sit alongside us and be directly engaged themselves. And that's something that we need to be evolving our model to keep up pace as well. But I think there's a general conversation ongoing, and I think it's on us to be part of looking at how the industry adapts and evolves to this, and part of that is also the discussions with the regulators, and making sure that we bring our expertise in terms of what control of these assets really is in terms of due diligence, and in terms of how you apply the existing regulatory frameworks into this space, because that's really what's needed in order to bring in those more regulated clients and that don't have a clear path into this area.
Do you think there is a lot greater regulatory clarity both for the custodian and the institutional investor, in the past sort of year?
I'm not sure that we've had the clarity yet, but I think we've seen moves towards, we've seen increasing interest from the regulators in multiple jurisdictions to educate themselves, and also then to take steps towards providing more clarity. So, things like, the EC consultation that's out at the moment, certainly additional engagement from the SEC in the US. It's going to be a long process, and I expect that we won't get all the answers that we need, in one burst. But you wouldn't expect that. It's going to be a process of comfort on the regulatory side, and really expanding and clarifying where that regulatory framework fits.
Just on the regulatory front, I think we have a global customer base where we have a third of our clients in APAC and EMEA and in the Americas. And you're starting to see more regulatory guidance. I don't know that I would use the word clarity, but I would definitely say that they're starting to take more of a proactive approach to providing some level of guidance in APAC. And then the Canadian entity just came out with some guidance recently too. So part of all of us on this panel is to engage with our customers and engage with those regulatory entities that talk about the space, talk about our technologies, talk about our security efforts, and how we're providing the flexibility and scalability without compromising security in a regulatory framework.
So there is very much an ongoing dialogue with regulators.
Has to be, yeah.
And are certain markets, sort of certain geographic markets, easier to establish that dialogue in, would you say?
I think everybody's willing to listen and learn and understand. I think that there may be some preperceived notions of cold and hot, and I think that story needs to change and evolve into a very flexible, scalable, secure platform, and you can design certain structures to fit your parameter of security. Yeah. I think that's where the conversation needs to go in order to scale the space securely.
Pete, would you say we've sort of moved beyond this narrative of hot and cold storage now in 2020?
I don't know. I think, first of all, talking about temperatures for security is a weird thing. How we got there, I don't know. Secondly, we have to be honest about how we're different, right? If you rewind the movie a year, you've got State Street and Boney and others that have a long, rich history of custody. Then you've got a bunch of crypto guys who call themselves custodians, like us, which largely were just software providers and vaults. Vaults for digital keys, weird thing, right? But that's what it is. So where does the business really go? The business is going very much the direction of traditional financial services. We're all finding a way to start to meet in the middle, in my opinion. So BitGo's business, for example, today has a sec lending business or a kind of traditional prime business that's growing and growing quite rapidly. All the things that we never did, that traditional custodians have done very well, ourselves and others like us are working hard to develop. So it's better reporting, it's better tax accounting, it's an ability to really truly have a margin in the system. It's for us, we're unique because we've got better API connectivity and stronger API connectivity. I think we're connected. The plumbing we've built from an API perspective is, I believe now, 190 exchanges and over 50 market makers. So there's likely a role that we should play in this network effect that happens as exchanges ultimately come together into one thing. I think the whole notion that firms like us are going to single-handedly disrupt and capture this whole market is flawed. Again, these are personal views. And the notion that traditional firms are going to want to recreate on their own from scratch the stuff that we've done for the past 7 years and all the lessons we've learned the hard way in digital, in managing and holding digital securities is probably flawed. When we look at the client universe, that was your question earlier. So we divide the client universe into kind of 3 core buckets. And we may have named them incorrectly, so I apologize if we have. Institutional investors, which are traditional money managers and buy and hold investors. That includes family offices and mutual funds and endowments and pensions and everything we know well from traditional finance. There's a crossover universe of those folks, and now there's a native crypto universe of those folks. For the moment, the bulk of the business with those folks has been done with the native crypto guys. We spend a lot of time banking them well, but also working with the crossover folks who, as I said in an earlier discussion, are coming in earnest. The next group we call leveraged investors. That's hedge funds, high-frequency traders, broker-dealers, those folks that want to approach us and have a relationship with us in which they trade more frequently and they like to use leverage. Again, there are both native crypto versions of that and the giant macro funds, as they start to come over, are going to have a meaningful impact. One unique wrinkle in this whole thing that doesn't get talked about enough, in my opinion, is that the high-frequency traders dominate the flow right now. The amount of flow that goes through a relatively small universe of high-frequency traders is considerable. I won't say alarming, but considerable. And then the last bucket for us are what we call execution services clients. So those are exchanges and market makers and folks that largely use us for wallet technology. And as I said, we're lucky because we have a brilliant founders of brilliant technologists who just built a phenomenal technology and has great user-friendly APIs. So we view the world quite simply from a client perspective and very much along the lines of the way traditional financial markets operate.
The 2 big buckets talked about there, the high-frequency traders and the exchanges, you also mentioned that hot and cold is a bit of a strange sort of way to refer to these digital assets. But those 2 groups, they need to be able to, I presume, to access those assets very, very quickly. And so are we essentially going to be heading towards a sort of fully digitized custody solution for cryptocurrency?
I think you're going to, first of all, I think when it matures, and it's happening quickly, a user of firms like ours, we're supposed to understand your business well enough that we provide a solution that solves your problem in a way that's unique to you. It's not just called hot and cold, right? The traditional asset managers are largely looking to us to store offline in cold storage. That's how they want to hold assets. That's how I hold my assets. Anybody who's a longer-term holder, I would recommend the same. So for us, they are bigger users of the traditional qualified custody cold storage vehicle than others. Leveraged investors want to have a combination of both, and they want leverage, right? So you provide a solution to do that, and then obviously exchange clients are largely using hot wallet technology. It was discussed on the earlier panel. I think where this all is headed quickly, and it's already happening, and we provide that service today, is the ability to trade from cold storage in real time.
Right.
So, and I think you'll see more and more of that happening.
I mean, I think from our perspective, we take a little bit different of approach, right? So, at the end of the day, given where the space is in terms of folks really no one, as far as I'm concerned, has a deep enough balance sheet to provide the level of credit that I think, is traditionally seen, right? So you're pre-funding on exchanges, maybe you're working with a Genesis or others, with some level of leverage, or you're borrowing from a Celsius or somewhere else, right? And so we're really focused at the end of the day on active movement, right? And the ability for someone to take advantage of capital and for that capital to be deployed, right? And so, from our perspective, we have clients that are doing upwards of 10,000 transactions per day, right? All on an API basis, all on an API-enabled basis, and actually moving coins on-chain, right? That becomes an important, set of activities that our customers need to execute. And from, the concept of a warm, hot, or cold perspective, we're focused on active, right? And so at the end of the day, infrastructure has to be there to allow those type of movements. The ability to enable APIs to kind of automate those transactions have to be there. And the level of compliance and operational, rigor to trigger, what I'd say are the right threshold protocols also have to be there. Now, there's some clients that are looking at it and say, hey, we're comfortable relying on a third party to execute that. And then there's others where, at our point of basis, if you look at some of our clients, they are doing them themselves. And so when we go and sit with the SEC, or we sit with NYDFS, or we sit with anyone else, we're able to actively, engage the regulator about how those things are being done at the edges.
Yeah.
Folks may want that to be done at the core, but we've actually expanded the service set to be able to bring what are traditionally things that happen at a financial service entity or perspective with pretty significant capital out to the edges to allow folks to be able to operate those businesses and go in front of regulators and let them know that they're doing those things the right way. So, I mean, I think it's a mode of what you need to do. If you're an asset manager, as Pete says, or a large financial institution, Fireblocks probably or may not be the place for you, given some of the regulatory scrutiny. It might be BNY, it might be Straight Street, it might be BitGo. But we think about it as a manner of really developing what we think are the right services to be able to step up to the type of regulatory scrutiny that's needed to service clients.
It's funny to see all the unique purviews that we all kind of take and how we address our customers' needs. I mean, we built the Ledger Vault platform with the front, middle, and back office in mind, and all actionable, accountable, traceable, auditable capabilities for an institution like a Bank of New York or State Street or JP Morgan or whomever, and established massive amounts of governance and conditional workflows that you can design per each wallet. So if you have Bitcoin wallet number 1 and it's over 50, it has to follow this conditional workflow. Or it could go, and those are all flexibilities and governance workflows that we put in the hands of the client to design and integrate into their existing workflow system. So again, our job is to make sure that we have end-to-end security, whether it's at rest, kind of in a warm situation, or completely in motion, that there is no compromising in every aspect of approving that workflow and securing that workflow.
We touched a little bit there in some of those examples on sort of reporting. I don't know to what extent the sort of the the fact that all of this is on-chain makes life easier for custodians. But Sven, maybe you could talk a little bit about the partnership that you've recently struck with Gemini, the exchange, that sort of reporting pilot and how that works.
Very quickly, I mean, it's a partnership which is open architecture, so it's not exclusive to a particular provider to say, if and when a traditional asset manager that would be a client of State Street, if one of those guys would be interested in investing in crypto assets such as Bitcoin, there would be a next day solution. They could open a custody account, so to speak, at a crypto custodian, and what we are able to do is taking in the information about their positions there, any movements to that, and include this into our existing reporting. And it comes back to what I said earlier around this idea, an institutional investor with a portfolio is now adding a small percentage to in crypto to his existing portfolio, and they don't want to have a new setup, a new process, and want to receive it out of one hand. The issue really is, again, the level of uncertainty, because if you think about custody, what it really means. This whole idea around, and I very much agree with this, we need to get away from these terms like hot and cold storage and other things. The traditional banking industry is using HSMs today. We are dealing with crypto keys all day long. That's the SWIFT network is run on this and has been for a long time. There's nothing unique or terribly exciting about this. The issue is, as a custodian, I need to demonstrate a level of segregation and a level of control. And the problem in the context of Bitcoin is the fact that there's no issuer. So if I lose my keys, it's gone, but also have no way to enforce it. I have no way to demonstrate right now to a regulator that if I take hold of these private keys, that this is segregated. Because today, if I open an account at another bank, the legal framework will make it clear that these are not assets of State Street, so in case of default, they can be taken out. And none of this legal structure exists for Bitcoin. So therefore, at a future stage, a lot of these functionalities actually can come into traditional banks, but it's not for the lack of technological capabilities right now. It's more of the, are we clear what the requirements are for any other custody activity? There is a level of market standard. I can say good custody in that market for that asset means X. What does it mean for crypto? So therefore, we are exploring at the moment these kind of partnerships where we give basically clients the flexibility to choose the key storage solution they like and just make sure we're connected and provide as seamless of access as possible.
So building up this kind of governance framework, that really is a key step in spurring on institutional adoption of these assets, would you say?
It's maybe a strange thing to say as a bank saying I need more regulation, but this is one of the areas where it's important. Carl mentioned the current consultation from the EC Commissioner, a few of the other areas. We're not asking for regulation for the sake of regulation, but we are asking for clarity in terms of guidance and best practice. What is a safe and secure way to handle private keys? And there's a lot of people in the room, and they're all very great ideas, but I need to take now a few as a regulated bank to say this cold storage is better than that cold storage. How do I decide this? And how would an auditor of our organization look at this and say, well, yes, you looked at all the right things to make sure this is done properly. For that, we need something. That may be a piece of regulation, that may be some supervisory standards that will help us to make sure here are the points I'll be looking out for in order to be sure that you guys offer your clients a good service. And at the moment, we haven't established that at an industry level. Only each and every firm is taking an isolated view. And I don't think that's necessarily what institutional investors want. Coming back to what you said earlier, so what they're asking for, they basically, if they come to us, they want a level of safety. But at the moment, I don't have enough guidance from regulators to say what that actually means.
What about ensuring digital assets that are held in custody? Is that currently a sort of a similar challenge where there's just not established frameworks and providers?
We actually offer insurance with our offering. So we have a $100 million policy that's at Lloyd's of London Consortium that is quite complete, includes theft and loss of keys and bad activity, bad actors internally, et cetera. But we've also recently, and I mentioned this earlier if you weren't in the room, we've negotiated bespoke insurance on behalf of our clients where they can take advantage of the BitGo policy and then buy a bespoke policy that's unique to them and their holdings. And it's surprisingly inexpensive for what it is. I mean, it really, it argues that that the work that's been, this was a very, very deep dive, as you can imagine, of due diligence by the insurance industry and on us specifically. And it argues that they find these assets to be held quite securely. We all expected the premiums to come in much higher than they have.
Yeah. Same for us. We've been through this process now. I worked with a broker and an underwriter and achieved a similar policy for $150 million for our clients. We're not passing that cost on to the clients. It's part of our offering.
Right.
And our clients have the opportunity to now work with that broker and work with that A+ Lloyd's underwriter to secure their own insurance in association by standardizing the vault. So we've saved them about 6 to 9 months worth of evaluation, security evaluation, processes evaluations in by doing so. As a tech provider, we didn't need to do that, but we did it because our clients were asking us to do that, because we wanted to streamline that process, put a check in the box from the underwriter and the broker to say, okay, now is about a month process for our customers to obtain their own insurance if they wish to do so.
But is that kind of coverage a fairly new phenomenon in the market? Because as recently as last year, we were hearing from new entrants saying, it's a first of its kind.
It's just like this whole space, it continues to evolve, right? So the underwriter is an A+ Lloyd's underwriter. We are the first technically connected platform that they've underwritten. Everything else has been traditional cold storage. So we've been able to enhance and show them our security protocols end to end and say, this is perfect. So we'll be able to cover you.
I mean, I think that speaks kind of to where we are as kind of a technology provider, right? We've gone through that exercise. We've done it with 2 insurance companies, to be able to do that and provide insurance and have our clients then go and speak and get their own coverage, right? I think at a secondary basis, we understand that there are gaps in service, right? And so really at the end of the day, part of what we've done a little bit is try to solve for those gaps in service, whether that be insurance, whether that looks at, broader ecosystem plays, accounting and reporting and other things that are necessary to integrate, chain analysis from a compliance perspective or elliptic. These are things that we're actively exploring to say, look, how does a person, a group that has limited resources or is thinking about optimizing, resources, really get a solution that provides, an end-to-end view of what they need to do from a business perspective. And I think with our focus, from a platform perspective and an ecosystem perspective, it becomes important to then understand what's going on, where our customers are finding value, and then look to kind of combine that value in one place such that they can actually go to market and focus on what becomes important for them, whether that's creating the best central limit order book, whether that's creating, a great lending platform, whatever that might be, that should become the focus. We as a technology provider then try to piece together all the different parts such that you can then go to market and not necessarily have to worry about all those different things.
I think you should assume on insurance that we all expected that we were going to have something novel, and in the end, we immediately did not, right? So we all are suddenly insured. We can argue about whose coverage is different. That'll bore you guys more than you're already bored. The question in my mind personally remains, what's the depth of that? Like, how scalable is that really? I mean, so if anyone in the audience is interested in buying a bespoke policy for whatever holdings they have from any custody provider, I would argue that it's time to be paying attention to that now, because I think there's a $100 to $150 million policy that exists for every one of these non-traditional folks. They don't need it, we do, for obvious reasons of balance sheet, right? Yeah. I don't know how scalable that is. If we tried to turn this into a $10 billion insurance policy broadly around the marketplace, I don't see it being there at the moment.
But can I add on this? I fully agree with you. But therefore, the scalable solution for me is not insurance, because it's always limited. For me, the scalable solution is showing a level of segregation. So you have a digital custodian, they keep your private keys. Worst case scenario, that custodian goes under. How do you get access to these private keys and basically port this somewhere else? Right. That something that we need to do, and then you can scale it up, because that's traditionally how we would look at any other asset market as my first port of call. It's not, do you have insurance, but can you actually segregate the assets so therefore they are free from a claim?
Yeah. I mean, I think
we would agree with that.
Yeah. I mean, from our perspective, we utilize multi-party computation, where, everything is segregated. It's not commingled, right? So when we talk about instances and we take folks to insurance, they're talking about their own instance that's being set up, and as a non-custodial solution, it is fully dedicated to them. You're right. Like, if we're thinking from a massive, scale, there's probably not enough capacity out there to cover that, and not every customer is looking for insurance, right? So at the end of the day, from a business perspective, it may or may not make sense to get, $150 million or $200 million worth of coverage, because what our client demand for that's not necessary, right? They're comfortable with what we're taking from a technology perspective. We're SOC 2 Type 2, and all the other things that we need to do to kind of prove that, we are doing things the right way. But we want to have, the option available for folks to be able to do that, and I think that's where that comes through.
And, the reality is custody done perfectly is supposed to be incredibly boring.
Right.
Yes.
That's the reality, right? You're supposed to not have a whole lot of dialogue regularly with your custodian. The systems are supposed to work, and you're supposed to feel that it's completely safe. That entire history of, that entire operating history for financial firms has been thrown sideways because these assets are irrecoverable if they're lost, largely. So we're going through that process right now as an industry of trying to figure out how to make this as safe. We think we all believe we have a solution that's safest. How to make it as safe as we can, and frankly, start to make it boring again.
Yeah, we hope so.
But there's some things that are happening in the industry that aren't great. This whole concept that to trade on an exchange, you have to give them the counterparty credit you risk that you take by giving 5 exchanges fiat so that you can trade on them doesn't exist in any other market. Right. This concept of this vertical, I'll be your custodian and your exchange and do your reporting, and that doesn't exist.
Well, let me pick you up there, because it sounds like we are agreeing on many things on this panel. I'm keen to find something that we may disagree on. I mean, I don't know how we all feel about that. Do we all agree that exchanges should not be in the business of custody on this particular panel? I know that if we had some businesses here, they would disagree. Do we have anyone that does disagree with that?
Again, it's not my purview to say. I think that's all going to be for the regulatory bodies to decide. I think if you look at the existing, exchange environments that we have in the traditional markets today, it's not allowed in the U.S. equity markets. But you look within Germany and Asia, they're the full stack of providing trading and clearing and settling, whether it's the Hong Kong Stock Exchange or Singapore Stock Exchange or the Deutsche Börse. And there's custodians in the U.S. and there's the DTCC in the U.S. So I think it's really all going to depend upon the securities regulators in each jurisdiction to figure out how they want to provide guidance and set up their infrastructure and their exchange custody setup.
Okay, well, I hope we've been able to keep you relatively interested in the boring subject of custody. Does anybody have any questions? I think we've got about 5 minutes, if anybody. There's one at the back over there.
This is a question mostly for Sven and Kara. The kind of message I'm getting from sort of a couple of panels is that the majority of institutional investors want an incumbent provider to come into this space. But do you actually want to be here? Like, do you see it as a question? Do you see it as a new revenue generating area, or do you feel that it's your responsibility to, as a safekeeper of assets, to naturally expand into crypto?
Thank you for asking that. We're dying to know that answer as well. Appreciate it.
Well, I'll go first. So I think, I would unpack it into 2 sides. I think there's one side we can't ignore and one that we shouldn't ignore. So the first one is around, tokenization of securities or tokenization of assets. That's our business today, right? That's really where our bread and butter is, and to look forward as to how this technology could transform that market would be bad for our business, right? We have to be aware of these changes and think about how they could transform our markets. Now, that may take 2 years, it may take 5 years, it may take 10 years, it may never happen. But it's certainly an area that I think we have to be engaged in, because the opportunity for this this technology is significant, particularly in terms of the potential efficiencies it could bring to our industry and to our clients in terms of cost savings. If it's applied in the right way and all of the risks and the issues that we've been talking about are dealt with. I think on the cryptocurrency side, that's a market opportunity. Clients are interested, and we again want to be able to service them across multiple different asset types. But I think we won't be ready to get into that space until we have the appropriate regulatory, legal, risk compliance frameworks to do that. I think that the technology side we've talked about is reasonably straightforward in compared to the other aspects that need to be addressed in that space. But I'm keen if we can get that resolved, and I think that's it's on us to try and to be at the forefront of this emerging technology.
I can fully echo this. I think we have a strong strategic conviction that security tokens and digital assets are important market change. We as an organization, our business is to service assets. If the very nature of those assets is changing, we want to be there and provide services if and when that market materializes. Crypto, I think, has its unique challenges, and now maybe going to give you more of a geeky answer, but nevertheless, I think that is important because that's what I mentioned earlier in terms of how this will play out. Just because there's an asset doesn't mean that you can take that asset into custody. There's a lot of stuff today that our clients are invested in that we don't necessarily service because these are not assets that you can hold in custody. And crypto, unfortunately, right now, or luckily, it falls into this category because you can only, like the custody rules of the SEC apply if you deal with securities and financial instruments, so Bitcoin is not covered by that. So in that sense, the fact that traditional banks are not providing services right now is not slowing down investors who want to make such kind of investments. So therefore, that is a very different value proposition. We want to be ready and support clients on their journey into the digital asset market space. And crypto may then be almost an extension, a new area that we are not active in today. So it's really a positioning strategy in terms of getting in there. So we're looking into this. You have some markets, particularly in Europe now, which are changing the legal framework around requiring basically a banking license if you start to offer crypto custody. So a lot of traditional banks are starting to look into this space. But I think the decision is for another day and not today.
Another point to add is that people tend to grumble that it's taking too long for traditional financial service providers and or regulators to react. I think it's happening at a really fast pace, personally. I mean, when you look at what we're really talking about, you're trying to completely disrupt the biggest industry in the world, in the history of man, and you're trying to do it in, a couple of years. And you're doing it at a time when, for the first time ever, you're changing it and disrupting it in a way that can not only create a lot of value, but can really, if done poorly, destroy unbelievable amounts of value, right? So I actually personally think that the pace at which this has happened, we all want it to happen more quickly, right? We all want to see Bitcoin go to 100,000, but do we want that at some larger risk than we are willing to take on? I don't know if we do, right? I think it might make more sense for this to happen at a pace that can be done really intelligently and really safely. Mm-hmm. But that said, the reactions of firms like these and the people that they have engaged and the staffing that's gone on and the total engagement now of the financial markets incumbents relative to 2 years ago is completely different. It's 180 degrees different.
Yep. Time for one last question. One over here. Sorry.
Hi, Patrick Martin, European Media Finance. Question, how do you see the new regulation for crypto and custody in Germany, and are you reacting to this in any way?
It may have to be a set of quick fire.
I'll give you a rapid
quick
fire. We think Germany is progressive, and we've just this morning announced that a BitGo, a German BitGo custodian, German entity has been spun up by us, that was announced this morning, and we will get set up to go in when the window opens November 2020. We think that BaFin's, as regulators scramble to figure out where they're going, we think BaFin's going to be at the forefront.
For us, it's slightly different, right? As a technology provider, it's what's needed to be able to support customers that are in Germany or looking to help folks engage in that market. So we're in pretty close contact with a few folks there to make sure we have a better understanding. You engage the lawyers and all the other things that come as a part of entering a new market, but we're actively engaged in making sure we can support people on day one.
Mm-hmm. Same. It's really all about supporting the clients. We have a whole legal staff within our headquarters in Paris working with the entire EU community and non-EU communities on regulatory fronts for the space. So we're heavily engaged, and again, we agree with Pete that they're definitely progressive, and we look forward to working with them to support our customers.
I think we'll have to leave it there. Thank you, everyone. Please join me in thanking our panelists.